So here is a summary of the components in a statement of cash flows. So you can see the operating, investing, and financing sections that we just discussed. There is also a cash reconciliation at the bottom of the statement that reconciles the change in cash with the beginning and ending cash balances. The ending cash balance on the statement of cash flows should always equal to the cash balance on the balance sheet. Preparing a statement of cash flows involves 5 steps. First, compute the net increase or decrease in cash. Second, compute and report net cash provided or used by operating activities. Third, compute and report net cash provided or used by investing activities. Fourth, compute and report net cash provided or used by financing activities. And finally, compute the net cash flows by combining the net cash provided or used by operating, investing, and financing activities, and then add this net cash flows to the beginning cash balance to prove that it equals to the ending cash balance. We will follow these steps in the preparation of statement of cash flows in our example. But before we start to prepare the statement of cash flows, let's analyze the cash account here. A company's cash receipts and cash payments are recorded in a cash account in a general ledger. The cash account is therefore a natural place to look for information about the cash flows from operating, investing, and financing activities. To illustrate, let's review the summarized cash T account on the slide here for the company Genesis Incorporation. So here, we summarize individual cash transactions in this cash account according to the major types of cash receipts and cash payments. For example, only the total of the cash receipts from all customers is listed. There could be thousands of individual cash transactions underlying these totals. But for the ease of illustration, we have these summarized figures produced by an accounting software. So after having the figures from the previous slide, we have to determine whether an individual cash inflow and outflow is an operating, investing, or financing activity, and then we list them out under the appropriate section. Finally, we have the statement as shown on the slide here. So under the operating activities section, we have cash received from customers, cash paid for merchandise, cash paid for wages and other operating expenses, cash paid for interest, and cash paid for taxes. So under the investing activities section, we have cash received from sale of property, plant, and equipment, and cash paid for purchase of property, plant, and equipment. Under the financing activities section, we have cash received from issuing shares, cash paid to retire notes, and cash paid for dividends. So after listing out all cash flows by activity, we calculate the net cash flows by each section. We sum them up and see the overall increase or decrease in cash. There is a second approach to prepare statement of cash flows, which is to analyze non-cash accounts. This approach is based on the fact that when a company records cash inflows and cash outflows with debits and credits to cash accounts, it also records credits and debits to non-cash accounts. So this is to reflect double entry accounting. Many of these non-cash accounts are balance sheet accounts. For example, when we sell a piece of land for cash, we debit cash and we credit land. Others are revenues and expense accounts, which will be closed to equity accounts in the end. For instance, we sell our services for cash. we will do a debit in cash, and we do a credit in service revenues, which will be closed to retained earnings for corporations. So all cash transactions eventually affect non-cash balance sheet accounts, right? And therefore, we can determine cash inflows and outflows by just analyzing the changes in these non-cash balance sheet accounts. The slide here illustrates the accounting equation to show the relation between the cash account and the non-cash balance sheet accounts. This illustration starts with the accounting equation at the top. It is then expanded in line 2 to separate cash from non-cash asset accounts. Line 3 moves non-cash asset accounts to the right-hand side of the equality where they are subtracted. This shows that cash equals the sum of the liability and equity accounts minus the non-cash asset accounts. Line 4 points out that changes on one side of the accounting equation equal changes on the other side. It shows that we can explain the changes in cash by analyzing the changes in the non-cash accounts, consisting of liability, equity, and non-cash asset accounts. So in other words, apart from looking at individual cash transactions in the cash account, we have an alternative method to prepare statement of cash flows. We can analyze the non-cash balance sheet accounts and any related income statement accounts to prepare a statement of cash flows. So we will illustrate how we use this approach in the next session. So here comes to the end of session 2. Now you can try the concept quiz to test your understanding in this session.